Today, most REITs are doing really well. REIT balance sheets are the strongest they've ever been, and REIT cash flows hit new all-time highs in 2022. This also fueled a lot of dividend hikes in recent months. Realty Income is one of them, Camden Property Trust is another one. They both hiked their dividend just in the recent weeks. But this does not mean that every REIT is doing well. On the contrary, there is now a growing number of REITs that are starting to feel the pain from rising interest rates and deteriorating economic conditions. As a result, I expect quite a few to actually cut their dividend in 2023. But which one are they? Hey everyone, this is Yossi. I run an investment firm that specializes in REIT investing. And in today's video, I'm going to highlight 3 REITs that I expect to cut their dividend in 2023. Now make sure to watch this video till the very end because you don't want to suffer a dividend cut, as this could lead to some significant capital losses. And still, before we get into it, if you could please like this video, it will help me very much. Thank you very much. So the first REIT that I want to highlight here is called Brandywine Realty Trust. Its ticker symbol is BDN. Investors like this REIT a lot because it's heavily invested in Austin, Texas. It owns a growing portfolio of life science buildings with rapidly growing rents. It also has a large development pipeline. And finally, and most importantly, it pays a 12% dividend yield. Moreover, the company just recently reaffirmed its dividend, and so this has left many people thinking that the dividend is sustainable. But the issue here is that the vast majority of the company's assets are still office buildings, mainly located in Philadelphia. Its occupancy rates have been declining in the recent past, and I fear that its rents are also going to face some pressure in the coming years, especially if we go into a recession. Brandywine would be just fine if it had little leverage and a low payout ratio. It would then be able to deal with its issues, but unfortunately here the company is quite heavily leveraged. Its debt to EBITDA is around 7 times. Its payout ratio is also high at around 90%. It leaves very little room for error, and I think that's almost inevitable that Brandywine is going to have to quite heavily reinvest in its office properties in the coming years, as it has to adapt to this changing work environment. Increasingly many people work in a hybrid setting, and so a lot of capex is going to be needed. Tenants also going to ask for tenant improvements as leases expire, and it simply cannot afford it based on its current payout ratio. Quite a few office REITs have recently cut their dividends to deal with similar issues. VNO, SLG, DEI examples that come to my mind right now, and so I think it's quite likely that BDN is going to follow their lead. Then the second REIT that I think will cut its dividend is called Modiv. Its ticker symbol is MDV. It's one of the newest IPOs in the REIT sector. It went public just last year, and it's already quite popular because it pays a monthly 11% dividend yield. But unfortunately here, once again, I don't think it's sustainable. The payout ratio is really high at 90%. So far, the REIT has been fine with such a high payout ratio because it owns mainly net lease properties that require very little capex. It also has very few debt maturities in the coming years, so that's a positive. But the issue here is that the company is currently in the process of selling its office buildings to reinvest the proceeds into industrial properties. And this wasn't dilutive in 2022 because it was able to sell its properties at cap rates that were comparable to the industrial properties that it acquired. But the market sentiment for office buildings has deteriorated quite a bit, and so I think that it's going to have difficulties in 2023 selling office buildings at similar cap rates. And so if it ends up selling these properties at, let's say, 6-7% cap rates, and then it buys industrial properties at 5-6% cap rates, so somewhat lower than those of office buildings, it's going to be dilutive. And with a 90% payout ratio, there's no room for error, and so I think a dividend cut is likely here. Then the third REIT that I think will cut its dividend is called Alexander's. Its ticker symbol is ALX. This REIT is mainly invested in office and retail properties in New York City. New York City is unfortunately facing growing pains today because a lot of companies have left to Florida and Texas and other business-friendlier states in the recent years. And then on top of that, the physical occupancy of office buildings in Manhattan, Brooklyn, and other places of New York City is today still very low at around 50%. And so this impacts also other property sectors, not just office buildings, because if people stay at home home and work from there. They're also not gonna then visit the retail properties that are in these locations. This recently pushed the two other New York City focused office REITs to cut their dividends. SL Green cut its dividend by 13%, then Vornado cut its dividend by 29%. And Vornado actually happens to be Alexander's biggest shareholder, owning around 30% of its equity. And so I think it's quite likely that it's going to push Alexander's to also cut its dividend to retain more cash flow to reinvest in its properties. And besides, today its payout ratio is already over 100%. And so I think it's very unlikely that it will be able to sustain its dividend. Now, if you want to learn more about other REITs that are likely to cut their dividend, make sure to click the link that I'll put on the screen somewhere. It will redirect you to another video that I filmed recently that talks about 5 other REITs that are likely to cut their dividend. And then if you want to access my REIT portfolio, feel free to join High Yield Landlord for a 2-week free trial. It's my REIT newsletter. I'll put a link in the description. Please like this video, comment below. Bye bye.